And good afternoon, everyone. My name is Jeffrey Tesch. I'm CEO of RCN Capital. Welcome to this week's webinar. This week we're covering acquisition strategies, and it is going to be a lively panel today. A big thank you to REI Inc., both Susan and Robert, who have put together these panels over the past 4 or 5 weeks. An amazing amount of information has been disseminated, and today will not be an exception. So let's get right into the panelists today. I'm going to start with my friend from all the way from Fort Worth, Dallas-Fort Worth, HomeVestors CEO, David Hicks. Welcome aboard, David.
Thank you, Jeff. Thanks for having me on the call.
A little bit about yourself and your company, David.
HomeVestors, people don't really know HomeVestors, but they know our advertising. We buy ugly houses. Our franchise has been buying houses since 1996. We have bought over 100,000 houses during that time frame. We have grown since 2009 from 165 franchises to up over 1,100 today. And our franchises are in I think, 47 states and 150 cities across the country.
Well, appreciate that. Thanks so much. Glad to have you on the panel today, David. And next up, Andy Probst, CEO of HomeRiver, up in beautiful Boise, Idaho. Hello, Andy.
Hey, Jeff. How you doing? Thanks for having me. I think I should give David a call because when the quarantine started, my house was pretty nice, but now it's pretty ugly with the kids staying home all the time. So I'll have to find that phone number locally and give it a buzz. But yeah, I'm the CEO of HomeRiver Group. We're a national third-party residential property management company. We do acquisition, renovation, leasing, management, maintenance, disposition, soup to nuts of a property. We're in 18 markets across the country. We manage about 13,000 rental properties. Most of those are single-family homes. We do have some small multifamily properties. But again, it's great to be on the call today, and we appreciate all your efforts to keep the community informed.
Thanks so much, Andy. And next up, Adam Stern from the Queen City, Charlotte, North Carolina, from Strata SFR. Hello, Adam.
Hey, Jeff. How are you doing today? Thanks for having me on.
Fantastic.
So just a little bit on Strata myself. Strata is a boutique real estate consulting and brokerage firm. We're focused on primarily 2 segments: the build-for-rent segment, which includes regional home builders throughout the Southeast, and also SFR portfolios from operators nationwide. Been in the industry for the last 10 years. I just launched Strat in January, and we're looking for opportunities to bring capital to good quality build-for-rent projects from as far north as Raleigh, as far south as Florida, as far west as Alabama.
Thanks so much, Adam. And finally, Charles Sell, CEO of Platinum Investment Properties out of sunny Hilton Head, South Carolina. Welcome aboard, Charles.
Thanks, Jeff. Appreciate you having me. Charles Sells from the PIP Group. I've been in business about 20 years. We specialize in investing in distressed real estate, which obviously a lot is coming down the pipeline here shortly. We invest in specific areas of the country, markets that a lot of investors traditionally don't consider to be the hot spots, if you will. But we'll get into that more, I'm sure, in this conversation. Thanks for having me.
Well, thanks so much, Charles. And finally, my name is Jeffrey Tesch. I'm CEO of RCN Capital. We are a nationwide lender in the private space focusing on non-owner occupied investment properties. Our company was formed out of the previous crisis in 2010, really taking our family office monies and deploying them nationwide to investors, not only buying, fixing, renovating, and selling homes on a short-term bridge basis, but also folks acquiring single-family assets for a longer-term rental, whether it be single asset portfolios or larger groups of properties across the nation. Really proud of what we've built at RCN Capital, family company of approximately 100 folks just outside of New York City and Connecticut, and a pleasure to moderate the panel today. So this panel that we have assembled really brings a wealth of knowledge. And today's topic is going to drill down on acquisition strategies. Acquisition from a lender standpoint, from an investor standpoint, and how your contacts have certainly been able to be successful yesterday, but more importantly, in the new era that we have engaged in and over the past 2 odd months, how are your folks being successful in today's marketplace? And David, I'm going to start with you today. As a gentleman that certainly has an amazing coast-to-coast presence with boots on the ground in just about every state, what has the communication been with your franchisees, and how are they winning today when it comes to acquiring those properties?
It's interesting because our franchises are much like anybody else. This market is very different than anything we've had before. But we have enough franchises that have been around since, for 15, 20 years that have some history and have some life experiences and understand that though this is a different crisis, that we will, at the end of the crisis, there is great opportunity for us. And so I think one of the things that we have tried to do is help our newer franchises learn from those that have been around and see that they really can buy in this market. They can be successful in this market. And overall, our franchises have done really well over the past couple months when we're in this crisis mode. It's amazing how they've adapted. They've continued to buy, and how that they have gone through that, because we're excited about the future of our industry and of this specifically our target market that we have. The good news is we've been buying for 23 years and through ups and downs in all kinds of markets. So part of what the message our franchises have heard from others is that you do adapt, but you figure out a way to deal with the challenge you have. Some of our guys are doing virtual appointments in markets they haven't been able to do appointments, but they're adapting and continue to buy. And we bought almost 1,000 houses last month nationwide.
Well, that's fantastic. Now, have the strategies changed at all? We certainly, across the nation, have gotten to know the We Buy Ugly Houses brand, and we certainly see the billboards everywhere. Has the advertising or the way that your folks are really engaging with the potential opportunities changed? Could you speak to that a little bit, Dave?
Yeah, it has. Our message has changed a little bit, but more than anything, the message is we're still here to help you. We're still here to buy that ugly house, and we are still buying. So more than anything, our message has changed that we are still buying. That though many of others have left the market, we're not, and we're still buying. We're still here, and that's probably the best part of the message that we've had. In fact, our franchises seem to the first month decrease their advertising a little bit, but now they're pretty much back to normal level of advertising. So part of the biggest thing is getting our message out there that yes, we are here, we are still buying, and we're still working within this market.
Love it. Great to hear those optimistic comments. And it seems as if each panel has gotten a little bit more optimistic. And Andy, I'm going to transition to you. With over 13,000 homes being managed across a wide geographic footprint, what are you hearing from your customers from an acquisition standpoint, and how have you changed things at HomeRiver?
Yeah, I mean, we've obviously reached out to a lot of our investors that we manage our properties for, just to see, how they feel about the market, if they're interested in potentially picking up new properties or potentially selling new properties. And generally, the consensus has been, hey, we're just going to wait and see what's going to happen. Initially, there was a lot of fear in the market, thinking that the tenant base was not going to pay from coast to coast, basically. And we compared our numbers, our collection numbers from February and March, and found that our April collection was just as good, if not better, than February and March, which surprised us. You know, initially we were thinking maybe we're going to collect 30, maybe 20%. Our delinquency would be 30 to 20%, which is usually 90, 95 plus. You know, after April was all said and done, we were in that 95 plus range. So a lot of the investors, I think, were initially scared after they got their rent checks last month, are kind of in wait and see mode. But I still feel like there's a great opportunity for build to rent property that we are doing a lot of lease ups on across the country. Once we saw lumber fall and labor fall, initially when this thing happened, a lot of the projects that were priced out that didn't make sense, my phone started ringing again, and these investors that were going to do these build to rent projects are back on the phone because rents haven't changed. They haven't gone up or down really. They've been about the same from February, March, and April, but the price to build has gone down quite a bit. And a lot of those contractors have freed up. Not necessarily because there's not demand, because there's just fear in the market, so they're not building as much. So that's kind of the opportunity that we have seen initially when this thing happened. But initially, our investors are kind of in wait and see mode.
That's very interesting. You're the first person that has commented on lower cost of materials to bring these single-family rentals up to spec. Can you talk a little bit about what kind of feedback you're getting on that and how that's making a difference for the investors?
Yeah, I mean, it's pretty interesting. We were pricing, small multifamily properties and single-family build-to-rent communities is early in January, and those numbers, like I said, you start putting pencil to those numbers, and it just didn't make sense. But like I said, if you look at the cost of lumber now, it's down 30% from its peak. You start plugging in that kind of number, which obviously lumber is the biggest material cost. Obviously, nail cost, everything else that kind of goes into it is down, not necessarily that much. But once you update those construction numbers, a lot of those projects start to make sense. And so we're seeing, like I said, a lot of people that have land tied up that said, hey, right now is not the time. They're back in the game. We're rebidding these projects, and a lot of them look like they're going to go because, again, the demand for rentals, especially single family rentals, when you're in an urban area and you're stuck in your house or your apartment, and you want to get out and do things. Those people are saying enough is enough. I want to go rent in the burbs. So we are not seeing any slowdown in leasing at all. In fact, we don't have enough inventory to rent to people.
Well, that is good news to hear. And that's a great transition to you, Adam. You're certainly single family rental is what you do. Are you seeing deals today penciling out that weren't before? Kind of give us an overlay of the SFR landscape right now from the single-family rental side of things.
Yeah, Jeff. So it's interesting. I'm always looking for where the opportunities are on the list side and where the opportunities are on the buy side. I look at the demand side and I kind of bifurcate it into two different groups, right? You have the institutional incumbents that are looking for certain things, and you have all of the other people that you wouldn't know that are kind of part of real estate private equity, apartment operators, and the like, family offices. And when I look at the supply side, I look at the fact there's opportunities because of this pandemic. There's also opportunities because SFR is a great asset class, right? So the incumbents, they are still buying, by and large, SFR portfolios. They're looking for opportunities where operations can be improved, where they can get things at a bit of a discount or even at market value, where they can increase the operating income of these portfolios. So when I look at the two groups that I focused on, which are, again, SFR industry incumbents, which include like the 11 or 12 largest REITs in the world, and probably 30 or 40 different firms that you never heard of unless you're part of the SFR industry. And I also talk to apartment REITs, apartment operators, private equity firms, family offices. I'm specifically looking for SFR, stabilized SFR portfolios for the incumbents and for the people that are part of the SFR industry, because now is a great time, because if someone's selling right now, they're serious about selling. Like no one that doesn't have to sell at this period in time, is actually going ahead with the sale. Because I think they understand all the headwinds they're facing. So what this time period has kind of done is kind of cleared out the room and has only left the really serious SFR portfolio sellers. And on the other side of the coin, when I focus on build for rent, there are so many apartment REITs and apartment operators that have come to me and said, hey, we normally build and stabilize multifamily apartment buildings because we know we can build it for, a 7.5 cap or an 8 cap and then sell it for a 5.5 or 6 cap or lower. And we see the same opportunity in SFR right now, where if they can align themselves with builders and they can build a project out to a 7 cap, they know this, short period of hurt is going to pass eventually, and that they can build and aggregate a large enough portfolio of SFR, they're going to be able to sell that for a lower cap rate and get a higher price somewhere down the road. So between stabilized portfolios of SFR, selling it to the industry players, and taking builder relationships and lining them up with, all the rest of the apartment and private equity players looking to build SFR portfolios, there's certainly plenty of opportunity on both sides of the fence.
Oh, that's very interesting. And I'll tell you, for the individual owners out there who are attempting to acquire, either small or mid-size aggregated single-family rental portfolios, are their strategies changing, or are they finding the new competition from these REITs coming in? Kind of give us a lay of the land on that.
Yeah, so with smaller, more entrepreneurial SFR funds, I think they're finding that there's an opportunity right now to run a strategy that's been run by mom and pops, for decades, probably even centuries, which is, to buy things in a market where the big guys aren't really competing. I don't know if everyone's heard, but some of the largest institutional buyers in SFR are now on hold. They're not buying things on market the way they were. So for smaller operators, it gives them opportunity to essentially, assuming they have dry powder and they have cash in the bank, and assuming their lending facilities are all still available, it gives them an opportunity to come in and buy the things they would normally get outbid by in the market by the big players. So I think those guys who have done a good job of lining up their capital and leaving themselves ready to pounce are probably looking at this like a big opportunity, a massive opportunity. And on the sales side, again, if someone's looking to alleviate themselves of inventory, whether it's new construction or whether it's things that are vacant that they got into recently that they just don't feel like they can sell or they can't sell, I certainly think they're becoming more reasonable on price in terms of price expectation, what they thought they would make. I think a lot of sellers, I don't think they're really ready to break even just yet. I don't think sellers are there yet, but I certainly think, we are seeing lower prices today than we did 2 weeks ago or even 30 days ago. And I think as the pain gets harder, more felt by these sellers, we're going to hit a bottom eventually. And I think maybe that might be sellers selling things at a break-even price, what they bought them for, 60 days ago, after putting in, $10,000 or $15,000 worth of work into it, So that's what I think I'm seeing in the smaller market for the private investors.
See, that's very interesting to me. The fact that folks would be willing to part ways, maybe not on a break even, but not as much. Is that liquidity driven? Like why are folks, especially with Andy was mentioning the outstanding rental collection numbers that we've seen across the country in April. Is it a liquidity issue for these folks, or why would they be willing to take less money at this point?
Don't forget, when this whole COVID crisis hit, there were, I don't know how many, but thousands of properties that had just been bought and were being renovated, or even pre-renovation that a lot of these firms had bought thinking they were going to sell retail, right? Or thinking they were going to spend the money and put renters into them. Depending on what people's strategies are, certainly people that were thinking about fixing and flipping retail 60 days ago, have properties. I know a bunch right now that they bought it for X. They thought they were going to put Y into renovations and sell it for Z. They're rethinking about spending that renovation money, or don't have access to that renovation money because their bank's not lending anymore. So all of that inventory that was like just bought, but either pre-renovation or just being renovated, that's all kind of fair game right now. That's where a lot of the inventory from, seasoned investors that I see are coming to market where they could be picked up for essentially what they bought them for, maybe a little bit more.
That's just great information for our audience today, and I really want everyone listening to understand what Adam was just saying, which is the opportunities are there today, even for folks who have recently picked up properties and are maybe looking to transition. The marketplace is active and certainly robust enough to begin acquiring properties. And Charles, certainly you at PIP Group have been certainly out there beating the drum for many, many years. What a solid investment, rental real estate, and certainly on the short-term fix and flip as well. What are you seeing, and how have things changed for you, Charles?
So just to kind of rehash what everybody else has said, we're kind of, what we do is we are, I use Adam's word, boutique in what we do. So we offer passive investments to our investors who want to invest in fix and flips and want to invest in, fix and holds, I'll call them. So as the pandemic hit, we saw a lot of our clients pulling their investments out. They were worried about how bad this crisis was going to hit, but our more seasoned folks, the REITs and some of the larger funds that we assist, they were actually doubling down and looking at this as a huge opportunity for us. As far as activity in the market itself, we do operate in those smaller markets, and the reason we operate in those smaller markets, and I'll tell you, we're in Savannah, Georgia, Augusta, Georgia. We're up in Greensboro, North Carolina. Very specific markets is because the big dollars are not there. As Adam said, they're all kind of on hold right now, waiting to see what's going to happen. But Blackstone has already called out to their investors to get ready for the next wave. And if you remember, Blackstone was the biggest buyer of distressed real estate in the last recession. So there is a holding pattern, but where we're at, we're actually increasing investors, and the activity that we're having is better than it was before this pandemic started. I think the reason being is people are just at home and don't really have anything else to do. They're scared to death of what's been going on with the stock market. I mean, a lot of people have lost their 401ks while others have made millions, playing these day trades. And just looking for something to be a little more stable. So I do think the private sector is what's going to repair this upcoming crisis, just like it did in 08 through 12. It is still kind of a wait and see. I think we'll see the worst of it, after we see what happens at the end of second quarter, and then there's another panic on the earnings, and it is going to be an opportunity for all of us that are in this space, regardless of whether it's SFR or flip or multifamily, that those markets for us or the inventory, the influx is going to grow substantially no matter what.
So, Charles, we're really focusing on acquisition strategies today, and clearly your company, Platinum Investment Properties, has a strategy that you have worked pre-crisis and continue to work. Could you maybe share some of the tips and ways that PIP has been successful working in these secondary and tertiary markets across the U.S.?
Yep. So talking about acquisitions, so to keep it on that subject, as I said, we focus on specific markets we feel that we have a good handle on, but also markets that, from what we learned in the last recession, aren't going to be so substantially impacted by job loss that like we're having right now. That's what made great markets in Dallas and great markets in Atlanta, but that's where also you get the pop-ups of the Blackstones and you get the pop-ups of the coaches and that sort of thing. So what we try to focus on are areas that are driven by industry. We've got the biggest port in the country. We've got a school called SCAD, Savannah College of Art and Design. It's a very, very wealthy school that has 5 campuses around the world. So the impact here, even though we are also tourism driven, it's very sustainable, whereas other areas are not going to be. Secondly, we always focus on properties that, I'll use the term recession proof. I've been using that term since 2012, and now I'm going to really have to put my money where my mouth is. But we select properties that would be good buy and hold and would generate a good yield. We select properties that are quick in, quick out. They're not going to qualify to the 1% buyers. They're going to qualify to the 99% buyers, which we know is how the government steps in and helps the recovery process, offering FHA, VA, that sort of thing. So those are the homes. That we focus on and that we buy. How we acquire those properties, we do it the old-fashioned way of the courthouse steps. HomeVestors is in our market as well. They buy ugly houses. I'd say we buy really, really ugly houses. We literally do title searches and skip tracing to acquire our acquisitions. And in the markets we do about 300 a year. So, we're certainly not on the scale of something like HomeVestors, but we're pretty confident in the markets that we're in. And we were boots on the ground long before this happened. So as far as we're concerned, this is just a great opportunity for us, and we just need to kind of wait and see how it plays out over the next 3 to 4 months.
Now, that's great input. And, I want to stay on this theme of secondary and tertiary markets. And Adam, I want to go back to you and certainly, with Own America in your previous life, certainly you really saw it all. Maybe talk a little bit about single family investors and how they look at, the major marketplaces across the U.S. or in these times, thinking about those secondary markets that often can be just as profitable, if not more.
Yeah. So, I've been in this since, early 2010. So I've kind of seen the proliferation of these different firms and size firms and what their strategies were. One of the things you got to realize when you're looking for opportunities is who the buyers are and what the opportunities that they want to see are. And I was always squarely focused on institutional investors and large-scale private equity type players. And it always seemed to, become apparent to me that the large-scale operators like American Homes Friend, Progress, Tricon, and all those big guys, they build infrastructure and they like to buy where their infrastructure is. They don't go outside of what they call their footprint, right? Then you have like the smaller, more entrepreneurial type firms like Charles, for example, great example of someone who looked at a market and said, all right, the big guys aren't here, so here's where I'm going to pounce. And he's likely built his own infrastructure there. I always kind of looked at it like the emergence of firms like Andy's HomeRiver Group gave smaller entrepreneurial firms the ability to go into other tertiary markets without having to spend the massive expense and time and energy and brain damage of building their own infrastructure in order to start buying there to say, hey, we like, Greenville, for example, we need to buy 100 homes before we start thinking about hiring our own property management firm. So let's go in there and hire a firm like HomeRiver Group to manage it. Like, it's easier now to do that than it ever was, or even possible to do before. So, the field's wide open for everyone from smaller players that might be day traders, like Charles said, that have a few $1 million and want to build a portfolio. All they got to do is figure out, first and foremost, where they like to invest. Second is what the infrastructure is going to be when they get there. A, are they going to build it themselves, or B, are they going to hire a third-party property management firm? And then, it's just a matter of finding the inventory. And there's plenty of players all over the place that can provide that. So it's changed a lot. Like, early on in the process, it was really hard to do all this stuff. You had to spend a lot of time and energy finding people to fill all these check marks. Now it's, you can get a good lay of the land by essentially going on a few webinars and seeing who the players are and gathering your team. I would think if you didn't know anyone else and you were starting from scratch, you could probably do it in a few weeks, after intently really studying the space. So kind of what I see, where we came from and where we are right now.
Interesting, interesting. And David, of course, once again, with your giant footprint across the U.S., certainly primary and tertiary markets, are your franchisees changing strategies when they really proceed into different marketplaces? And how do they think about doing that?
We focus on what our strength is. We have a consistent target market that we do across the country. Now, it varies based on the city because obviously Boston, that's a different price range than it is in Birmingham. But we stay and focus on that target. One of the things I think is real important you do, and I think Charles mentioned this, it's really important you learn what you do well and you focus on that and you stay with it. And then when you get into bumps in the road like we have now, you're able to go predict what's going to happen within that market. We're not the high-priced houses. We're the lower-priced houses, the ones that are used for rental properties that are consistent, and we stay and focus on that type of market. Now, at a time like this, when challenges come, if anything, you tighten your market just a little bit, and you make sure that you don't overpay. You make sure you buy them right, and when you do that, you can be confident that on the back end of it, that you have a consistent product that you can sell.
Well, that's a great segue into where I wanted to go next, which is how are we buying today and making sure that we're not overpaying, right? You know, one of the biggest, really the biggest caveat that our investors over the years is if you buy it right, you're much more likely to make money no matter what improvements you are making to it. And, you know, we learned this as a lender almost 10 years ago. If our customers bought it right, they almost always made money. And certainly it's been one of the hallmarks of HomeVestors. And I'm wondering, you know, how are you communicating with your franchisees today about buying it right in these uncertain times?
That's one of the real messages we have, because if you are and we're finding, and I think Adam mentioned that the other investors that paid too much earlier, if they paid too much for a house, they're having to try to get out of it now without maybe a break even or a loss point. But our franchises have always focused on paying the right price, knowing that market, and also making sure and taking into account a little bit more now what we call white elephant issues. If it's on a busy street, if it's backed up to a railroad, if it has issues like that, you need to even buy it deeper or be more conservative to buy it at all in this type of market. But I think the biggest thing we always focus on our franchise is buy a house so that you know that you can, at a price that it will sell for, and then sell it quickly. In a market today, when you don't know, right now, everything's selling. And it's interesting because people took stuff, the number of listings are down nationwide. And so right now, everything's selling. Because people that have a house that they're living in, they're hesitant to list it right now. So they pull those listings off the market. So vacant houses are selling very quickly. In fact, we have had one of our franchises in Boston listed a house on Friday, and he said he has 78 showings listed, scheduled before tomorrow. He already has 6 offers. And so stuff is selling quickly. What we also know is once this slows down a little bit and people get confident of what's going to happen, that those listings are probably going to come back in the market, and we don't know what the price is going to be then. So it's not only important to buy the house right, but it's to sell it quickly. And if you are rehabbing, rehab it quickly so you can get it back on the market in the same market you bought a house in. Not if you wait 6 months and do a 6-month rehab right now, who knows what that price is going to be sell.
Yeah, it makes a ton of sense. Speed is everything. And, one of the things, Andy, that a lot of our customers are speaking to us about today is, how they've been handling different situations that come up in their existing portfolio. In other words, if I have an urban setting and my particular home is vacant, do I treat that different than I have in the past? And, if we're doing showings, how do I treat them differently? And, any input that you would have for our audience today, Andy, on just how investors are thinking differently that you're seeing across your geographic areas.
Yeah, I have, and I'll do my best to tie it back into the acquisition opportunity. Obviously, you're seeing a ton of different regulation come down from the federal government all the way down to local municipalities, especially around, moratoria on evictions, right? That's a big issue. If people aren't paying rent, there's really not much you can do. You can make threats, but what we're seeing is, the mom and pop, the do-it-yourself or landlord, it's becoming very overwhelming because typically they don't have the technology pieces in place. So, we have awesome tech on our side called, Show Mojo, or there's Rently, where people can go into these properties without having an agent there to show them. They can go in, once they're done, we can clean it up, right? They can come on our application, they can pay online. So we have all these technology tools that, the guy that owns one or two rental properties doesn't have. So we can easily send our business development guys onto Craigslist or, HotPads, Zillow, and see all these for rent by owners listings and call them up and say, hey, we want to help you. And then they're saying, hey, this is way too much. This is out of our hands, because a lot of these people, they know their tenants are already a month or two behind. Now they can't evict them, and the tenants stop answering the phone, right? So they just don't know what all these changes are going to look like and how that's going to affect their portfolio. So we're seeing a lot of that going on the mom and pop level, just because there's just so many changes. Where the professional investor or the institutional investor is picking up what's going on and they're making adjustments accordingly. But those are the opportunities that we see for acquisition and for us to pick up new property management accounts in the market, because that's about 60% of all rentals are managed, by mom and pop. So that's a big opportunity for us. I think it's also a big opportunity for people that are trying to acquire investment properties.
Yeah, that's really well said. And I think Adam, certainly made a point, which is today we have investors that are entering the marketplace and they're attempting to acquire properties, and using the tools certainly that HomeRiver has created can go a long way to being able to broaden out not only the scale of their portfolio, but the geography of it. Maybe you could talk a little bit about how you're seeing folks today use different acquisition strategies by using, your technology to acquire over a much larger footprint.
Is that a question for Andy or for me?
For Andy, please.
Sure.
Oh yeah, I think just to piggyback on what Adam was saying is that they want management is obviously, and obviously this is my opinion, very important when you're owning investment properties. If you don't think management is important, hire a bad manager and you'll learn really fast how important it is. But if you can have one company that's in multiple markets that can get you outside of your primary market that you're living in, so you can diversify some of your assets, it's a pretty powerful tool. The technology is there for us to do that now. That technology 20 years ago wasn't there. So we do see a lot of people that are in, low cap rate, compressed markets, California, et cetera, saying, hey, I'm gonna get out of here. I'm gonna go, sell half of my assets here. But, HomeRiver Group, for example, we manage property in Sacramento, but we also manage property in Memphis, Tennessee. They can sell half of their assets there, 1031 into Memphis, Tennessee, and get the same statement at the end of the month, managed by the same company. So if there's an issue, you can, make one phone call. That's pretty powerful. And that option wasn't there 10 years ago. And now, because of technology, we have that option because of, the cloud-based technology, Show Mojos, the Property Melds, which is our maintenance scheduling software. we can do a lot of this stuff from remote locations that we couldn't do 10 years ago.
Yeah, it's super interesting. And what I want to do now is, first off, remind everyone on the call today, there is a question box. Feel free on the screen to go ahead and enter any questions that you have, and we'll attempt to leave some time at the end to be able to answer those audience questions. But, David, I want to go back to you for a minute, and it seems a recurring theme about not only short-term buying and selling, but also folks buying and holding for longer-term rental portfolios. I would love to know a little bit about HomeVestors, how you've been using different acquisition strategies to not only buy and wholesale or renovate, but also buy and build out rental portfolios, and how you folks are thinking about that today, Dave.
Yeah, virtually all of our franchise ended up with rental portfolios. We average probably right around 14% of the houses our franchise buy, they put in rental portfolios. And it was interesting to hear Andy talk about the rent coming in, because I was talking to a couple of our franchises recently, and one of them in Houston, he says he was predicting, pretty low rents last month, and they ended up with 97% rents paid. Another one in Kansas City, real close to the same. And I think both of them have 300 or 400 properties that they manage. So it's the rental market is a lot of our franchises end up using their business to buy and sell houses for their current cash flow, and they develop a rental portfolio for their future, for their retirement, for their wealth development part of it. And it is a strong strategy, and I don't know that there's a better strategy than it.
Yeah, no question about it. And, from individual buying properties, Adam, I want to go back to you, because you had some great points about institutional and then moving down into sort of the mom and pop investors acquiring properties. And I would love for you today to talk a little bit about sort of the thresholds on when investors who want to make owning single family rental portfolios their full-time job, sort of, what benchmarks do they have to think about, and how they use those acquisition strategies to get to those benchmarks, and really, where they can take it from there, Adam.
Wow. Outside of asking you to repeat that question, because it was a long one, I'm going to try to answer it my turn. I thought it was interesting to hear David say that, his HomeVestors franchisees, by and large, all have rental property portfolios, because that's, the more I talk to HomeVestors franchises, the more I know that's true. And I kind of built a career around the idea that people like HomeVestors franchises and others wanted to retire or quit their jobs and just do this for a living. And there's a big audience of people out there that have been able to do just that. But when it comes to building SFR portfolios, there's a lot of different strategies you can use in order to achieve whatever your goal is, whether it be to, quit your job and just do that for a living, or whether it's to, place some of your capital in a place that's steady and that's, likely to earn you a good return. Whatever your strategy is, there's a lot more to building a portfolio than you think. When you look at what you want to accomplish, you got to start thinking about what the end goal is. And I'll just take it from like the smaller investors that build SFR portfolios, guys that, or people that buy 10 or 15 or 20. Their goal might just be to, create cash flow in order for them to pay their bills and to supplement their income. And then it's all about buying cash flowing properties that, are able to cover the debt service and provide good cash flow. And that those kind of portfolios are all over the place. People are buying properties, renovating them, putting tenants in them, and managing them for cash flow. Then you have others that are kind of less cash flow conscious and more appreciation conscious, and they look for more of an area, like good schools, close to amenities, things that will likely help the appreciation over time. They'll cash flow less, but they'll be kind of, better and more steadily appreciating assets. And then you have institutional investors that a lot of them have the strategy of buying or building a portfolio at a certain cap rate And when they get to a certain scale, they'll exit at a lower cap rate. Because what I've come to understand is the larger a portfolio is, the higher the price relative to the market value that they'll achieve, because scale is a really important thing. So it's in a long-winded way. I guess it depends on what size investor you're talking about. You know, the vast majority of investors that own portfolios are medium-sized investors, people that own between, call it 5 and 20 properties. And without a doubt, you know, looking at optimizing your portfolio to make sure the NOI is as high as it could possibly be, staying on top of deferred maintenance items and making sure the operations are zipped up. When I see people like that selling their portfolios, they get as close to market value as you can get, and they get a really efficient exit. Those who don't pay attention to those little things end up taking a much larger discount, and sometimes that's by plan. Sometimes that's them being okay because they made more cash flow by not operating as efficiently as they could. And then they exit, and they made all the money along the way, and they take a discount, and they're happy. But, you know, when you really look at what your strategy is, you got to keep focused on the fundamentals, what the end goal is, and how you manage your portfolio in order to get there. And then those decision points become relatively easy because you have a roadmap in order to get to the end goal. So hopefully that helps and makes sense.
Yeah, no, I think that's perfect. Typically, these REI webinars, we have a lot of new investors who are really interested in trying to figure out how to get to that next level. So that's really good advice. And Charles, you know, I know over the years your company has transitioned not as many flips and more certainly building out the rental portfolios. And how do you have conversations about that and how it makes sense to determine whether or not we're going to be flipping or we're going to be holding for rental income, and try and answer that question from the acquisition strategy perspective, please.
Right. Okay. So we represent that small collective that Adam's referring to. So we're not representing we do have institutional investors, but you know, that's really not our bread and butter, if you will. As we saw this happening, we did start changing and transitioning and communicating with our clients that, you know, we should be thinking about moving to buy and hold. You know, we were just absolutely, you know, kicking it really well with the flips. And quite frankly, we still are, but it's just watching what happened in the last recession, knowing we have an unemployment rate of what I think it's 25, 30 million right now. This can is going to continue to get kicked down the road, and buy and hold for SFR is going to be a major role. It's an inevitable part of the fact. There's going to be a lot of credit hurt. People aren't going to be able to do anything but. From the acquisitioning side of it, you know, I would refer back to David and your comment of buy right. Everything we buy it, and even though we might consider it for the flip category, we want to buy it so, you know, if this situation were to arise, which now it has, it's going to cash flow well too. So it's going to have pretty good cap rates. If you're buying in certain areas where those institutional buyers are buying, and Adam hit on it a little bit as well, their margins are much smaller and much thinner than what, you know, a mom and pop can afford, or the guy that wants to buy 5 properties or buy 25 properties. You know, he may need, you know, a 10% net cap on that when you know, some of these institutional buyers are happy with 2. So it's another one of those things when you're thinking about acquisitions, and I think all of us have tried to push this through the industry over the last 10 years, is investors no longer have to invest in their backyards. Technology has come so far that you can do everything with all the different companies that are out there, everybody that's on this call. You can do it well and more successfully in areas around the country than particularly your backyard. So that is definitely something to consider when you're thinking about acquisitions. You know, some people, they get caught up in the oh, it would be so cool to to have this rental portfolio and collect the rents and all of that. But I can tell you, the guys on this call, that tenants are a very, very difficult business. With our buy and holds, we actually offload that to property managers. We do still make money in the transaction, but if we were to manage that in-house, it would be a loss leader for us. So acquisitioning wise, to try to keep it on that topic, is don't necessarily think of your own backyard. If you're, Charlotte is a great market, but my margins, if I were buying in Charlotte for buy and hold, they would be very small, and everything in Charlotte is pretty expensive real estate. So you can't find those good buy rights at $50,000, $60,000 and be able to rent that property after you fixed it up, for $1,200-$1,300. That's essentially the sweet spot for us.
Well, I appreciate that, and I'm going to transition now to a few questions that have been coming in, and I'll tell you, multiple questions here, so I'm going to want to get feedback from our panelists today. Multiple questions on foreclosures and what you experts think is coming down the pipeline. David, I'm going to speak with you. The audience wants to know, are we entering another era of foreclosures, and what do you think?
It's interesting. This is different than 2007-8 period. 2008, we came in with an overabundance of inventory. There was in fact, it was driven by real estate. Today, you're coming into it with almost the exact opposite, in that there's a very low level of inventory, and they're not building many houses, especially in the lower price range. I think you may see an increase of foreclosures in the higher priced houses. I think even if you do in the lower priced houses, I think it'd be quickly absorbed and won't impact the market much at all. But I do foresee a higher priced market that could be an issue.
So overall, you do not expect to see an uptick in foreclosures of any measurable amount. Is that what you're telling our group today?
I think there will be an uptick in the higher price market. I think you'll have an uptick in foreclosures. I do not think it'll have a devastating impact on prices in the lower market, because I think it will be quickly absorbed by the sales in the lower part of the market, which is where we play.
Fantastic. Same question to you, Andy. What are you seeing coming down the road from foreclosures?
I agree with everything David said. Also, if you look at the delinquency numbers, they're close to all-time low, right? There's not a lot of people missing their mortgage payments currently. And then the government, I think, is going to do almost everything they can to prevent, another housing crisis. Which, look, I don't know what the market's going to look like after July if there's truly 30 to 40 million unemployed people out there, but they're getting an additional $600 a week for being unemployed. Some of those people are in a better position to pay their mortgage in the crisis than they were beforehand. So I don't think there's going to be a ton of foreclosure. I think you might see some, but I agree with David. The people I think that are in trouble recently purchased, higher price homes, 500 to a million plus homes, and there's no relief for those higher wage earners out there. So I think that's going to be the immediate opportunity. But who knows? Everything changes so fast. Nobody really knows.
Great. I'm going to transition to another question for Adam. We've been seeing multiple questions about financing, Adam. Certainly, you're involved in large-scale portfolio transactions. What are you hearing from your lenders and the ability of financing out there?
Yeah, happy to talk about that. And one other thing, in terms of foreclosures, I don't know what's going to happen or what's not, but certainly when I see rain clouds on the horizon, I get an umbrella. So what I'm doing right now, whether it happens or not, is pulling all my people that have foreclosures, that manage foreclosures, that get that inventory, and making sure that all of those relationships are solidified. So when and if it does happen, I have channels to inventory that are that if it does actually hit the market, that I have that inventory coming to me. So just my 2 cents on that subject. In terms of financing right now, it's certainly a challenge. The secondary market for what they call non-agency paper, that's debt that is not bought up by the FHA or other government entities. That secondary market is essentially, not functioning correctly right now, which means all the lenders who offer non-agency debt are either not lending anymore, or they are lending at much non-attractive terms. They're requiring higher LTVs, they're requiring higher interest payments, less attractive terms. So, I myself have had deals fall through where, buyers had their financing lined up for, construction financing or even permanent financing once the, construction phase of projects have been completed. And because the secondary market is not functioning all that correctly right now, and because banks are not lending, that's causing firms that buy built-for-rent projects or SFR portfolios to either rethink the purchase at all or rethink the pricing that they were assuming prior, pre-COVID. So it's having a major effect on, how portfolios of existing SFR are trading and how new construction projects are being handled. I would reasonably believe that any deal that got struck prior to the COVID pandemic kicking into high gear likely has either stalled or has been restructured now that kind of the new reality is upon us.
Appreciate that feedback. And then finally, Charles, I'm going to put this question to you. We've got multiple questions on here regarding Airbnb, vacation rentals. How do the experts see those coming out of the crisis? And since you live in vacation land, who's better to answer than you?
Yeah, we're feeling that pain personally. Actually, we have a $450,000 condo that's been empty for the last 2 months. But yes, it's a convoluted answer to the question. Those that have the Airbnbs or the VRBOs, obviously those are more or less second homes for most people, and they can afford this crisis and come up with some creative ways to work around it. We've just started advertising ours again. People are coming back to the island again. They just opened up food and beverage outside today. We will see that come back. So I don't really see it being a big impact on Airbnb or VRBO. A lot of times with Airbnb, obviously it's a shared room. If somebody is needing that shared space or the income from that shared space to pay their mortgage, that obviously could be a challenge, or that could have now caused a crisis. But for the most part, I don't really see it being that big of a deal. I'm glad we're not in that one that we did with you guys last year. Certainly, that was a $4 million beach house that we flipped. And I certainly wouldn't want to be caught in that situation right now. But everybody here on the island doesn't seem to be too terribly concerned about it. All our neighbors own 1 or 2 condos, or a house near the beach, or my doctor has 1 second row, and so we always talk about it, and it's like, yeah, it sucks, but. It is what it is, and we'll recoup it next year. So it really hasn't been that big of an impact here.
Great feedback. Really appreciate that. And I'm happy to be out of that $4 million loan as well, Charles. So appreciate that. So, yes, we are at the top of the hour, and I got to tell you, today it was a tremendous amount of information to both the small, mid-sized, and large investors out there. I cannot thank everyone enough. David, Andy, Adam, Charles, super job, great content for all the investment community across the nation. Once again, a big thank you to REI Inc., Suzanne, fantastic job pulling this panel together. Robert, thank you so much. Really, really well done. So that's it for this week. Next week we will be back here same time, and we will be discussing rehab, fixing, flipping, and the new realities. Will be another great panel with tons of information. Signing off, Jeffrey Tesch from RCN Capital. Thanks so much. Have a great afternoon.
Thank you.
Thanks, guys.
Bye-bye.
Thanks, Jeff. Appreciate it.
Bye-bye. Thanks.
You guys.
Be safe, guys.